Welcome back to the Deep Dive, where we take the fire hose of sources you've shared with us, articles, corporate filings, strategic analyses, and we try to turn it into potent distilled knowledge.
That's the goal.
Today, we are cracking open a company that really, it shapes the social landscape of America in a way that very few others do. We're talking about an alcohol giant, one whose products are so ubiquitous, there is, well, a statistical certainty one is probably chilling in your fridge all now.
That's absolutely right. We're diving deep into Constellation Brands, Inc. And this isn't just, a collection of familiar names on the shelf.
No.
This is a Fortune 500 behemoth. It's an American producer and marketer of beer, wine, and spirits that somehow manages to fly a little bit under the radar, corporately.
Right, while completely dominating consumer choice.
Exactly. And the complexity of its strategy, of its growth, it just far outweighs the simplicity of, a six-pack.
When you look at the sheer scale of this operation, you realize pretty quickly this isn't just about selling beverages.
Not at all.
This is a story about colossal capital allocation, aggressive M&A, and some strategic bets that have fundamentally altered the entire beverage industry.
Big time.
Okay, let's unpack this. Before we get into the history, the long journey, give us a sense of just how massive their footprint is, especially in the U.S. beer market.
Well, their dominance is built on a really specific and kind of non-traditional foundation. Constellation Brands is, by sales volume, the largest beer import company in the U.S.
The largest import company.
Yeah, think about that. They didn't build this market dominance from scratch with domestic products. They bought their way to the top of the import category.
And how does that stack up against the big domestic players?
If you look at the total market share, so across all major beer suppliers in the country, domestic and foreign, Constellation holds a pretty significant 7.4% market share.
So where does that put them in the rankings?
That positions them as the third largest major beer supplier overall. They're just trailing the massive, the global conglomerates.
And those market positions, they translate into truly staggering financial figures. We looked at the 2021 data, and the numbers are just astronomical.
Yeah, they're huge.
This company recorded U.S. $9.355 billion in revenue.
Right.
But maybe even more telling of its corporate ambition, its reach, is its total asset base. That clocked in at U.S. $27.104 billion.
And that level of financial muscle, that's what allows them to make these strategic moves that small competitors, they can't even dream of it.
It's not just a company, it's a force multiplier in the consumer packaged goods space.
It really is. And what's particularly fascinating about Constellation Brands is that, unlike some of these established giants who kind of resist change, this company's story is defined by its willingness to aggressively invest in frontier markets.
Like the cannabis bet.
Exactly. The massive controversial bet they made on cannabis, which we're definitely going to analyze in detail.
So our deep dive today is to understand precisely how this powerhouse was constructed. We're going to trace its unlikely path from its, ridiculously humble origins.
Truly humble.
Starting as a tiny regional bulk wine seller to the diversified multi-billion-dollar empire it is today.
Right.
We need to dissect the massive strategic pivots that defined its recent history, specifically that game-changing antitrust-mandated beer deal, the continuous clinical shedding of low-margin brands.
And the high-stakes controversial leap into cannabis.
And finally, we have to examine the operational and legal friction that such rapid, aggressive growth naturally generates. I'm thinking particularly about water rights in Mexico.
A huge issue.
So to really appreciate the magnitude of Constellation Brands today, we have to travel all the way back to the Finger Lakes region of upstate New York in 1945.
Yeah, and it's a classic American entrepreneurial story. It started with, like you said, very modest ambitions.
It was founded by Marvin Sands, right?
That's right after World War II. And it was initially called Canandaigua Industries. And if you think about the Finger Lakes region, it was, and it still is, an agricultural area well suited for growing certain types of grapes.
Mostly for bulk wine, not the fancy stuff.
Exactly. The kind of grapes used for bulk or fortified wines. That was their niche.
Their initial business model, it wasn't craft beer or premium Napa Cabernet.
Oh, no. It was the simplest business model possible.
Yeah.
Just selling bulk wine.
So just massive quantities of it.
Yeah, their job was to source the product and then sell it wholesale in these huge quantities to bottlers all throughout the eastern U.S. It was a high-volume, low-margin business, just designed to move a commodity product efficiently.
And when we talk about its starting size, it's almost laughable compared to where they are now.
It's incredible.
In that first year, 1945, they managed to sell roughly 200,000 gallons of wine. Now, that sounds like a lot of liquid.
It does.
But the financial return was just minimal. Gross sales for that entire year totaled only $150,000.
$150,000. It just underscores the monumental effort it takes to scale a business from the ground up.
But the foundation was solid. It was centered around family, around continuity.
That's right. The business grew steadily, and they formalized its structure in the early 1970s. It incorporated as the Canandaigua Wine Company, Inc., in 72.
And then they went public.
Then a critical step, they went public in 1973. And this move from a private family venture to a publicly scrutinized corporation, even while it was still regional, it provided the capital structure they needed for future expansion.
And the family leadership, that stayed a constant, right? It provided stability through decades of, just monumental change.
It did. Marvin Sands was the founder, but his son, Richard Sands, he took over as president in 1993 and then CEO in 96. He eventually succeeded his father.
And then another Sands took over after him.
Yeah, later Richard's brother, Rob Sands, became president and CEO in 2007. So that Sands family involvement, it maintained a very specific corporate culture that was just focused on aggressive growth and market opportunity.
And they weren't afraid to acquire early on, even when their focus was still just on wine.
No, not at all. A key indicator of their future M&A strategy came in 1987 with the purchase of the Manischewitz winery.
Manischewitz, really?
Yeah. And while Manischewitz is, a niche, specialized brand, acquiring it showed an early ability to fold established, known brands into their growing portfolio. And they still license and sell that name today.
But the truly pivotal moment, the one where they signaled to Wall Street and the entire beverage world that their ambitions were way bigger than New York's Finger Lakes, that happened right at the turn of the millennium.
That's right. In the year 2000, they officially changed their name from Canandaigua Wine Company to Constellation Brands, Inc.
And why dedicate time to a name change? What does that really represent?
It's the ultimate corporate mission statement. It signifies a profound strategic shift.
They were signaling a new direction.
Completely. They realized the old name, Canandaigua Wine Company, it was just too limiting. It anchored them to a specific region and a specific product.
Wine company.
Yeah. Exactly.
Yeah.
The new name, Constellation Brands, it signaled that they were now a vast collection, a whole universe of brands spanning multiple product categories and geographies. They were shedding the identity of a regional producer and just fully embracing the identity of a multinational beverage giant.
It's smart corporate branding that successfully reflected a global mindset. And today, that global mindset is physically anchored in Rochester, New York. It's a neat piece of corporate continuity.
It is. Their headquarters are still in Rochester. In fact, just this past June 2024, Constellation opened its new, massive 170,000 square foot campus.
Where did they build that?
On the site of the historic Aqueduct building in downtown Rochester. And this move, it wasn't just logistical, it was civic and symbolic.
How so?
Well, it was noted in the regional press that Constellation Brands was the first Fortune 500 company to operate in the city of Rochester in 2 decades.
Wow.
It just underlines their status as an economic anchor for the region. It's a powerful illustration of the distance they traveled from those first $150,000 in bulk wine sales.
And that distance was covered primarily through the strategy we're diving into now. The relentless acquisition spree of the 2000s and 2010s.
This is where it gets wild.
Yeah, here's where it gets really interesting, because Constellation Brands didn't just buy companies and sit on them. They systematically engineered their portfolio through these aggressive purchases, followed by really clinical strategic divestments.
It was a constant process of optimization.
A churn.
A total churn. The M&A strategy is the true story of Constellation's transformation. The goal wasn't just to get bigger. It was to migrate their revenue base away from high-volume, low-margin products.
The stuff they started with.
Right. And move toward premium, high-margin prestige brands.
Let's look at the sheer speed and scale of that initial global expansion in wine and spirits.
The early 2000s were just a blur. In 2003, they immediately expanded globally. They acquired BRL Hardy in Australia and Nobilo in New Zealand.
So instant global footprint.
Instant exposure to the rapidly growing New World wine market. Then the following year, 2004, they made a massive domestic statement. They acquired Robert Mondavi Corp, for $1 billion.
1 billion. And Mondavi is synonymous with premium California wine.
Exactly. It instantly gave Constellation the prestige and the pricing power they desperately needed.
That Mondavi purchase alone redefined their entire wine division, and they quickly followed that up with another huge international play, right?
Yep. In 2006, they acquired Vincor International, which was Canada's largest wine company, for $1.44 billion.
So not just a brand, but the whole operation.
Oh yeah, this wasn't just a brand acquisition. It was purchasing entire vineyard operations, distribution channels, and market dominance across an entire nation. They were becoming a truly global player.
And they're moving into spirits at the same time.
Absolutely. Spirits generally carry higher margins, and they're less susceptible to, agricultural volatility than wine is. So in 2007, they acquired Spirits Mark 1.
And that brought them Svedka.
That brought them Svedka Vodka.
Yeah.
Then in 2008, they bought Beam Wines Estates for $885 million, which included major assets like Clos du Bois. So by the end of the decade, their portfolio was immense, but also, critically, it was bloated.
And that bloat is what leads to the second, equally important part of their strategy, the premium pivot. Why keep buying if you're just going to sell off older brands at the same time?
It's pure financial engineering. It's focused on maximizing profitability per unit.
Right.
Those low-cost mass-market wines, like the ones they started with, they require colossal volume and massive, expensive distribution networks just to turn a small profit.
Whereas the premium brands...
The premium brands, like a Mondavi or a specialized spirit, they sell at much higher price points. That means you need less volume to generate significant profit and much better returns on investment.
So they systematically shed their value brands to sharpen that focus. What are some of the key examples of this divestment strategy?
Well, it began almost immediately after the major acquisitions. In 2008, they sold off classic, high-volume but low-margin properties like Almaden Vineyards, Inglenook Winery, and the Paul Masson Winery in Madera, California.
And then they did the same with spirits.
A year later, yeah.
Right.
They completely exited the value spirit space, selling that entire portfolio to the Sazerac company.
And this isn't ancient history. This strategic shedding continued right into the last few years.
Yes, which shows this is a constant, ongoing process. In January 2021, they executed one of their largest portfolio cleanups. They sold 30 low-cost wine labels.
30 labels in one go.
30, including Clos du Bois to E&J Gallo for $810 million. They are effectively saying, we will only manage brands that meet a specific, high-margin, premium target profile.
It's that constant optimization that drives their stock price and their financial health.
Exactly.
But all of these strategic maneuvers, all these billion-dollar wine and spirit deals, were utterly eclipsed by one single defining acquisition that cemented Constellation's status as a true beverage titan.
A big one.
The beer deal of 2013. This is the moment Constellation became a household name.
This was the moment the cash machine was plugged in. In 2013, Constellation acquired Grupo Modelo's U.S. beer business.
Which is the entity that sells all the major Mexican beer brands in the U.S.
Corona, Modelo, Especial, Pacifico, all of it. They got the U.S. rights to all of it.
And crucially, this was not a voluntary sale on the part of the original owners. This was mandated by antitrust regulators, correct?
Absolutely correct. The global brewing giant, Anheuser-Busch InBev, or AB InBev, they were in the process of acquiring Grupo Modelo worldwide.
Right.
The U.S. Department of Justice, the DOJ, stepped in and said, essentially, if you, AB InBev, acquire Modelo, you will control way too much of the U.S. beer market. It'll restrict competition.
So to get the deal done, they had to sell something off.
To satisfy those antitrust concerns and be allowed to finalize the global deal, AB InBev was forced to divest the entire U.S. business to a competitor. And Constellation Brands seized that once-in-a-lifetime opportunity.
This makes the resulting transaction so complex. What exactly did Constellation secure that gave them such immense power?
They gained three critical things that really guarantee their long-term dominance. First, full ownership of Crown Imports LLC, which was the existing importer and distributor.
Okay, so the operational side.
The operational side.
Yeah.
Second, complete independent control over the U.S. commercial business marketing, sales, pricing, distribution, all of it.
And the third piece was the real prize.
The most valuable asset, the foundation of their entire business today, was the third, an exclusive perpetual brand license in the U.S. to import, market, and sell Corona and the Modelo brands.
A perpetual license. I mean, that's basically an asset with corporate immortality. They don't just rent the brands, they own them forever in the most profitable beer market in the world.
Exactly. And the license grants them freedom, too. Constellation has the ability to develop brand extensions and innovations specifically for the U.S. consumer
Without needing approval from the global owner.
without needing approval from AB InBev. And this is the root of the friction, the lawsuits that we'll discuss later.
That's a huge competitive advantage, but there's also a key operational detail tied to this deal that dictates the whole supply chain today.
Yes, the manufacturing. As part of the deal, Constellation Brands acquired a brewery and the responsibility to manufacture these products in Mexico, specifically for the U.S. market.
Ah, so they make it, but only for us.
Right. Grupo Modelo, which is still owned by AB InBev, handles production and sales for every other country globally.
So you have a situation where the Corona sold in Los Angeles is produced by Constellation.
But the Corona sold just across the border in Tijuana is produced by AB InBev's subsidiary. It's an antitrust-mandated split personality for a global icon.
With the beer division secured as this extraordinary high-margin cash engine, Constellation continued to look for the next wave of growth.
They did.
Post-2013, they started aggressively targeting high-end craft products and premium spirits, hunting for the next big thing.
And this quest, it led to some of the most expensive and frankly riskiest investments in their history. The acquisition of Ballast Point Brewing of San Diego in December 2015 really stands out as a stark strategic lesson
Because of the price tag.
because they bought it for an astronomical $1 billion.
$1 billion for one craft brewery. Looking back, was that valuation just wildly irresponsible, even at the peak of the craft beer bubble?
Financially, yes. I mean, it was based on an extremely optimistic projection of unlimited rapid growth that just never materialized.
So what was the thinking?
It was essentially a desperation purchase to gain instant credibility in the highly fragmented, premium-priced craft sector. That billion-dollar valuation was roughly 10 times Ballast Point's annual revenue at the time.
So they thought they could just scale it up.
Constellation believed they could leverage their massive distribution might to make Ballast Point a national brand overnight.
But that growth never materialized. What happened?
The craft beer market, it matured rapidly, competition intensified, and consumer tastes just splintered.
Right.
Constellation realized they had vastly overpaid, and they were struggling to integrate this, artisanal brand into a corporate structure designed for industrial-scale imports.
So the key takeaway here is not just that the investment failed.
No, many investments do. The key is that Constellation had the financial discipline to accept the massive loss, write down the goodwill, and just get out.
And they did get out quickly. They sold Ballast Point to a tiny suburban Illinois company, Kings and Convicts Brewery, just 4 years later in December 2019.
It's a textbook example of admitting a billion-dollar mistake and executing a strategic correction.
Meanwhile, they were making smarter, more targeted moves in high-end spirits, where the margins are often more consistent.
Right, and more insulated from those mass market trends.
What were their successful spirits plays during this period?
In 2016, they acquired High West Distillery in Park City, Utah, for about $160 million.
High West is known for high-quality whiskey and bourbon.
Exactly, hitting that key premium profile. Yeah. They followed that up in 2019 with a majority stake in Nelson's Greenbrier Distillery in Nashville, Tennessee, further solidifying their position in American whiskey.
We also see the continuation of that buy and sell volatility in the craft beer and niche wine space, though.
Precisely. They bought Funky Buddha Brewery in Florida in 2017, a well-regarded regional craft brewer, only to sell it back to its founders in 2023.
And the Gary Vaynerchuk wine brand.
Yeah, they acquired Empathy Wines in 2020, co-founded by Gary Vaynerchuk, trying to tap into that direct-to-consumer wine market. And they bought Copper & King's American Brandy in 2020.
So the strategy remains the same.
It's clear, relentless pursuit of niche, high-growth categories, but with a very accelerated timeline for success. If a category doesn't perform quickly, they cut their losses and move on.
Which brings us to what is perhaps the most audacious, highest-stakes bet in Constellation's entire history.
A big one.
The beer division was a cash engine, but every growth company needs the next frontier. They found it in 2017 when they decided to step completely outside of alcohol and into a market that just stunned the entire beverage industry.
Legal cannabis.
Legal cannabis.
This was revolutionary. Constellation Brands became the undisputed pioneer, signaling to the entire Fortune 500 that cannabis was a legitimate future market. The initial entry point was in October 2017.
Walk us through that initial massive leap.
Constellation agreed to pay approximately $245 million, that's about $191 million US at the time, for a 9.9% minority stake in Canopy Growth Corporation.
And Canopy Growth was what, exactly?
A Canadian seller of medicinal marijuana products. It was a toe dip, but a very, very expensive toe dip, into a nascent, highly regulated market.
And why was that move such a corporate landmark?
Constellation Brands became the very first Fortune 500 company and, crucially, the first major alcoholic beverage maker globally to take a stake in a marijuana business.
The significance of that can't be overstated.
It was immense. It signaled confidence in the eventual federal legalization of cannabis in North America, and it hinted at a future where alcohol and cannabis products might share distribution channels or even integrate into new beverages.
But they didn't remain a minority investor for long. The following year, they doubled down in a way that just defied market logic at the time.
They went from toe dip to total immersion. In August 2018, Constellation announced an additional astronomical investment of US $4 billion in Canopy Growth.
$4 billion.
Yeah, this huge infusion of capital increased Constellation's total share to 38%. And the timing was strategic, coming just before the legalization of recreational cannabis in Canada that October.
$4 billion. That's a capital commitment you typically reserve for building, I don't know, multi-billion-dollar manufacturing plants, not investing in a company in a market still federally illegal in the United States.
Right.
What was the rationale for such a gigantic bet?
The rationale was first-mover advantage and leveraging expertise. Canopy Growth's leadership said the funds would be used as rocket fuel for international expansion and future marketing, explicitly focusing on high-margin, consumable product formats.
Like drinks.
Like cannabis-infused beverages and sleep aids. Constellation's thinking was clear. We are the best in the world at distributing high-end beverages and building premium brands like Modelo and Corona. We can transfer that expertise to the inevitable cannabis beverage market and dominate it.
They wanted to become the Modelo of marijuana.
That was the dream.
But when you make a $4 billion bet on a market that is fundamentally volatile and constrained by regulatory red tape, how quickly did the reality of the market clash with that dream?
Almost immediately. I mean, while the Canadian market legalized recreational use, the rollout was slow, it was fragmented, and the black market proved incredibly resilient.
And the U.S. market?
Crucially, the U.S. market, which Constellation needed for that massive $4 billion investment to pay off, remained federally illegal. That severely limited Canopy's ability to operate or even list on major U.S. exchanges without regulatory friction. And the stock price of Canopy just collapsed as the initial legalization bubble burst.
So this led to massive impairments on Constellation's balance sheet, a $4 billion bet that became a serious financial drag.
Exactly. Constellation had to repeatedly write down the value of its investment, taking substantial hits to its earnings. The lesson here is that even with unparalleled distribution and branding power, you cannot beat regulatory friction and market volatility in a frontier industry.
Right.
That immense cash commitment acted like an anchor during a period when their core alcohol market remained immensely profitable.
And this leads us directly to the strategic correction. Despite that massive initial enthusiasm, Constellation Brands has been steadily stealing back its cannabis involvement since 2023.
The retreat is clinical. They began explicitly signaling a move back from the cannabis-infused drinks market, which had been the initial target.
They cut their losses.
They've reduced their stake in Canopy Growth through various financial mechanisms and have publicly signaled that they might withdraw completely. It perfectly mirrors the Ballast Point situation.
How so?
Constellation is willing to take enormous risks, but they are equally willing to execute a swift, painful, multi-billion-dollar correction if the targeted returns fail to materialize on their aggressive timetable.
The story of Constellation Brands is one of spectacular, almost reckless growth, but it's underpinned by this remarkably disciplined strategy of premiumization.
Right.
But when a company operates on this multinational scale, manufacturing billions of bottles and cans for massive markets friction with local communities, competitors, and regulators is absolutely inevitable.
It's guaranteed.
This brings us to Section 4. The operational footprint and the recurring pattern of legal and ethical challenges.
The core engine of Constellation's revenue, the beer division, it dictates a highly specialized and somewhat unique operational structure. To satisfy the demands of that 2013 perpetual license, they have to produce enormous volumes of Corona and Modelo for the U.S. consumer.
And they have to do it in Mexico.
They must do it in Mexico.
So what does that massive Mexican manufacturing network look like today?
They currently operate 2 massive breweries, One is in Nava, Coahuila, which is near the Texas border,
Mm.
and the other is in Ciudad Obregón, Sonora, near the Pacific coast.
And to ensure that supply chain runs smoothly, they've pursued vertical integration.
Aggressively. In 2014, they finalized a joint venture with Owens, Illinois, and acquired AB InBev's glass production plant, which is right next to the Nava Brewery.
Wait, they actually own a glass factory?
Yes. That's how critical it is to control the supply chain when you're moving billions of units.
It makes sense.
By owning the glass plant next to the brewery, they control costs, they ensure bottle quality, and they minimize transportation delays. It's a logistical fortress designed to make sure the U.S. market never runs out of imported beer.
However, this necessity of using Mexican natural resources, particularly water for mass production, led to intense community friction, which resulted in a multi-million-dollar disaster in Baja California.
The Mexicali brewery controversy is a classic case study in global corporations underestimating local environmental and political resistance.
What was the plan there?
Constellation planned to build a third major brewery in Mexicali, Baja California. It was an investment worth over $1.4 billion. However, that project was never finished.
And this was due to massive civil unrest, wasn't it? Tell us about the water rights dispute.
The dispute turned into a massive geopolitical and social flashpoint. The brewery was designed to consume vast amounts of water from the already highly stressed Colorado River system.
And Mexicali is a desert.
A hyper-arid region. Local populations, farmers, and activists argued vehemently that the water was essential for human consumption, local agriculture, and regional stability.
It wasn't just a local issue either, because that water serves an entire coastal metropolitan area.
Correct. The water sourced in that valley is critical. It supplies Mexicali, the surrounding agricultural valley, and it's piped over the mountains to coastal cities like Tijuana, Tecate, Rosarito, and parts of Ensenada.
So the community felt that Constellation...
They felt Constellation was prioritizing corporate profit over basic human and environmental needs. The protest became so widespread and intense that the Mexican government was forced to intervene.
What was the ultimate outcome of that community backlash?
It was a shocking defeat for the corporate giant. The Mexican government held a public referendum, and the community overwhelmingly voted no to the brewery project.
Wow.
Imagine being a Fortune 500 company, having a multi-million-dollar state-of-the-art manufacturing plant already partially constructed.
And having it halted.
Halted entirely, because you failed to properly calculate the geopolitical and environmental sensitivity of the single most crucial resource in a hyper-arid region.
Yeah.
It was a failure of local due diligence at a global scale.
And how did Constellation resolve the operational shortfall?
They pivoted, again, demonstrating that corporate flexibility. Instead of trying to force the issue in Baja California, they announced they would build their third brewery in Veracruz, Mexico,
A region with more water.
a region situated near a river, mitigating the acute local water scarcity concerns that plagued the Mexicali project. It was a very costly, humbling lesson.
Moving beyond operational friction, let's look at the recurring pattern of legal and ethical headaches that come with managing global brands. Let's start with a throwback to 1991, predating the Constellation name, the infamous Cisco wine controversy.
The Cisco case is highly illustrative of the ethical challenges of marketing alcohol. In 1991, the company, then still Canandaigua Industries, was forced to reach a consent agreement with the Federal Trade Commission.
The FTC.
The FTC alleged that the packaging and marketing of Cisco wine were deceptively similar to popular low-alcohol wine coolers.
Which were huge at the time.
Very popular. But the crucial difference was the alcohol content, right?
Exactly. Wine coolers were typically low ABV. Cisco, however, was a fortified wine with a much, much higher alcohol content, upwards of 20%, closer to port or sherry.
So the concern was that consumers would mistake it for something else.
The concern was that younger consumers, or those unfamiliar with the product, would mistake this colorful, sweet, deceptively packaged product for a lower alcohol beverage, leading to unintended and dangerous intoxication.
So the FTC made them change everything.
The agreement mandated a complete change in packaging and marketing to clearly delineate the product's strength.
Okay, then there's a controversy that hits right at the heart of the prestige wine world. The fake Pinot Noir scandal of 2010.
This was not a marketing issue. This was about authenticity and outright fraud.
This was a major international scandal centered in France. A French court convicted Constellation Brands, along with 11 other wine traders and producers, for participating in a massive fraud scheme that lasted between 2006 and 2008.
And what was the conviction for?
They were found guilty of selling fake Pinot Noir wine to U.S. buyers.
What exactly was the fraud? What were they selling instead of Pinot Noir?
It was a sophisticated scheme. It involved substituting cheaper, lower quality grapes, often Merlot, for the significantly more expensive Pinot Noir grape, and then labeling the wine as authentic Pinot Noir.
Just to boost the margins.
Drastically. Since Pinot Noir is a prestigious grape, this substitution just massively increased the fraudsters' margins. And Constellation was importing these fraudulent products and selling them into the U.S. market.
So Constellation was convicted overseas. What were the repercussions domestically for being involved in this kind of global fraud?
Well, Constellation later faced and settled a major U.S. class action lawsuit related to this. And the key legal argument against them, even though they weren't the ones doing the substituting,
Right.
was that as a massive, sophisticated global distributor, they should have known that the wine they were purchasing and reselling was fake.
Based on what? The price.
Based on the quantity, the price points, the logistics involved, it underscored their due diligence responsibility, or their lack of it, as the gatekeeper for these products entering the American market.
And finally, let's revisit the core of their business, the beer division, where the dynamic created by the perpetual license generates constant legal challenges. In 2021, they were sued by their former partner and current global brand owner, AB InBev.
This lawsuit perfectly illustrates the complexity of that antitrust-mandated split. AB InBev, the global owner of Modelo, sued Constellation Brands over the U.S. launch of 2 new Modelo-branded beers.
And the suit wasn't about selling too much beer.
No, it was about Constellation's right to innovate with the brands they control exclusively in the U.S.
What were the specific legal arguments over these new brand extensions?
The arguments hinged on Constellation pushing the boundaries of the license agreement, specifically regarding the Mexican identity of the brands. There were 2 main points.
Okay.
First, AB InBev argued that one beer illegally used the term tequila to describe the barrels where it was aged. Second, and this is the more philosophically telling challenge, was their argument that Constellation was inappropriately using the term bourbon to describe the barrels used for the second extension.
Why does bourbon specifically matter in this context?
The rationale was that bourbon has absolutely zero connection to Mexico. It's an American product with specific geographic and production requirements.
So AB InBev's argument was?
Their argument was that by launching a bourbon barrel-aged Modelo, Constellation was stretching the definition of their license and fundamentally violating the brand's core Mexican identity. They said it was confusing consumers and damaging the global brand integrity.
It's a clear case of 2 giants fighting over the limits of perpetual ownership and brand evolution. That legal friction truly underscores the incredible complexity of running a fractured global enterprise that is constantly pushing the boundaries of what's acceptable. It's a good moment to zoom back out and synthesize our analysis.
We have mapped the remarkable trajectory of Constellation Brands.
Right.
I mean, we started in 1945 looking at a local bulk wine cellar with a minimal $150,000 in sales.
Right.
And we tracked its transformation. Through decades of aggressive M&A and the clinical disciplined shedding of low-margin assets, it became this diversified, multi-billion-dollar company that just dominates the U.S. beer import market and commands a robust portfolio of premium wine and spirits.
The history of this company is really defined by its strategic audacity. Its willingness to take these enormous, bold, high-stakes bets on the future, but coupled with the executive strength to execute swift, strategic corrections when those bets don't materialize.
Think about the 2 largest corrective measures we detailed. That initial $1 billion purchase of Ballast Point, which was sold off just 4 years later to cut the loss.
A huge write-down.
And the staggering $4 billion investment in Canopy Growth, which is now being systematically scaled back. These moves demonstrate a remarkable financial calculus.
What do you mean by that?
Constellation is willing to pay very high tuition for market intelligence, but they refuse to pour more good money after bad. That's the definition of rapid, opportunistic, and sometimes, controversial growth.
And their operational failures, particularly the Mexicali water dispute, they highlight a universal business lesson. Global scale always brings hyper-local impact and scrutiny.
Always.
A company can successfully manage a $27 billion balance sheet, yet still fail spectacularly because it misunderstood the local necessity of a single resource in a remote region.
That tension between global ambition and local reality is constant. But let's end with a final provocative thought, tying back to the engine that powers this entire enterprise, that 2013 beer deal.
The exclusive perpetual license for Corona and Modelo in the U.S.
Precisely. Constellation Brands holds this exclusive perpetual license for the world's most profitable beer market, the U.S., while the original Grupo Modelo, owned by AB InBev, still serves every other country on Earth.
It's such a strange arrangement.
This arrangement creates a fascinating structural dilemma for these global brands. What does it mean for a brand's long-term integrity and identity when its biggest market is essentially handled by a completely independent, potentially competing entity?
An entity that has the legal freedom to launch products like bourbon barrel-aged Modelo that the global owner vehemently objects to.
Exactly. It raises these fundamental questions about who truly controls a global brand's destiny. Is it the traditional owner, or is it the licensee who controls the most profitable market?
That strategic friction where billions of dollars are at stake is an ongoing corporate and legal battle. That's definitely something for you to mull over the next time you reach for a six-pack produced by this complex corporate giant.
An excellent note to end on. Thank you for joining us for this deep dive into the anatomy of an American alcohol giant.
We'll catch you next time for more essential insights.